Hello. Today I am going to talk about the recent downtrend of Ethereum. I'm going to give my opinion on what I believe is the major driving force of this downtrend. I'm going to limit that opinion strictly to technical analysis. Outside forces such as the geopolitical markets, the current situation with Luna and its problems at that point may or may not play a factor on a global scale, but I don't have enough information to really give an informed opinion. So I'm going to avoid all of that and strictly focus on the science and mathematics of technical analysis. What you are looking at is the daily chart of Ethereum with a momentum line. I'm using a banded momentum that is based upon the high and the low of the candles. I find banded momentums provide opportunities above that show bullish, below that show bearish, and anything in between the band is kind of a consolidation point. So let's get right into this chart and talk about some of the situations that I see. Now, to understand why we are at pre-2021 lows, I think we need to look at the market in general. So on the right-hand chart, starting from March down, you see basically the second part of a downtrend. But if you really look, starting around November 14th, Ethereum started its major downtrend just as every other cryptocurrency did. Around the beginning of 2022, it somewhat stabilized out. So from the prospect of what I see, this is really one larger downtrend with a technical consolidation point between January and April, in that range. And we'll get into that in more detail as well. But for now, let's look at where this chart started. Let's look at let's get to right about here. Let's look at the massive bull run that led up to this significant correction. So we start, actually let's go back a little more. Okay, so here we go. Okay, that August of 2020 is technically the beginning of this bull run. And it has been a very large one, with July, August of 2021 being a bit of a corrective reprieve. But nonetheless, from the standpoint of this market, it is severely overvalued. The technical analysis shows a very unhealthy trend. You should not see a market in an uptrend this long without some intermittent corrections. Corrections are healthy, as that corrects the value of the asset to a more realistic level. Seeing this asset so drastically overpriced shows really that a severe correction of the magnitude we have seen since November should be expected. This is literally the after effect. That is what we're seeing right now, is the after effect of this massive bull run. Bull runs at this level are dangerous and unhealthy to the market. And an asset with the market cap and dominance of Ethereum, controlling the entire ERC20 network and all of the tokens based upon it, is extremely problematic and just looking for a major correction of the magnitude that we are seeing take place. Now, even when the correction first started, back in November, the momentum behind the correction was still trending upwards. But as the markets began to show more and more corrective balance, basically by the beginning of 2022, when price action crossed below the momentum, and we entered a brief consolidation period. This area here, where the momentum somewhat stabilized out. Some would call it a false bottom, but I think that's inappropriate. It needs to be called what it is, a loading point or a plateau within the correction, where the market tested against the value to determine if it was where it needed to be or if it was needing more correction. And ultimately, through supply and demand and pressure, the market demonstrated it needed more correction. You cannot have the kind of bullish run that this asset had and not have some kind of extreme correction to counterbalance it. From the technical analysis standpoint, this type of a market had to have this kind of extreme correction to bring its price back down into a realistic level representing its true value. I know that's an unpopular opinion, but the realization is this process must happen naturally. Through supply and demand, through buyers and sellers, once an asset simply becomes too overpriced, buyers aren't interested in it, and sellers get stuck holding it. That's the balance between fear and greed. And bull runs are just a pure greed notion running unchecked. Bear runs of this level following such an extreme bull run is a reminder that the asset's value must be proportional to its true worth. Without that true worth, the asset simply becomes overinflated and no longer represents any true meaning. And I think we're going to see more and more of these extreme corrections as cryptocurrency leaves the world of trading and investing and enters the world of real monetary value. We have debit cards based upon cryptocurrencies. And I've talked about this before, where those debit cards now have real meaning and real substantial price to product ratios. As we continue to push in that direction of price to product balancing, you're going to see markets go through these kind of insane shifts. They have to happen if you're going to use an asset like Ethereum in a real world market condition. The price of the product must be reflective of the value of the product. And subsequently, this will continue. How long will it continue? Decides and is decided only based upon supply and demand of the consumers. A consumer is not going to pay more than they value the product. And that is a realization that must take place. And it must have a genuine root. For example, a fast food chain selling hamburgers. Customers aren't going to accept paying 0.001 Ethereum when the price of Ethereum can fluctuate from $1,100 to $5,000. There must be representative balance, and that balance must occur logistically and technically within the asset. As people continue to migrate to the cryptocurrency markets and to migrate the cryptocurrency markets into the real world applications, balance will take place, because then it's no longer an intrinsic asset of investing. It is now a monetary framework that now has consequences of volatility. So let's look at a lower time frame and get a closer look at the downtrend itself. Now, there are geopolitical issues that have taken place, but those are beyond the scope of this discussion. As you can see, though, from here, technical analysis does indeed show around April that very lulling point I spoke about, where the markets consolidated to some degrees with a brief rally around the 14th of March to roughly April 11th. That was kind of a push to see if the market was ready to go back up into a trending state. Had the market reached the corrective value between supply and demand, between buyer and seller, and roughly around April 19th, it's clear that the market had decided, actually probably closer to April 21st, the market had decided it has not corrected enough. A lot of people are blaming institutions for moving in and pushing prices down so that they can get into a stranglehold position like they did with the mutual funds. Institutions are only interested in making money. And if there's no money to be made, they wouldn't be wasting their time. Ethereum is a pillar within the cryptocurrency communities, and the ERC20 framework is a massive money-making framework on multiple levels. Any token that runs on that framework only aggregates to profits in the long run for Ethereum in general. So the monetary principle behind it necessarily means larger pools of money are going to take an interest in it. A lot of this is hype, a lot of this is FUD, and a lot of this is consumer sentiment. And there's not really much difference at any level between one or the other, just because the overall underlying principle of the success of Ethereum as a merchandisable product speaks for itself. So now let's move into a more mechanical look. Let's start actually analyzing profitability through money-making contexts. Now I've just loaded a full Jackrabbit recipe onto this chart, and it has made 76 trade cycles with its current settings. I'm going to go down to a lower time frame. First, let's start with the 1 hour. So on the 1 hour time frame, you begin to see that over the last 900 plus days, this approach has had successful 60 completed trade cycles. So 60 times it has profited in the last 900 days at the 1 hour time frame. So even with that massive downshift, money was still being made. And as you can see, by following it back, this type of an algorithm is capable of understanding opportunity. Just like the institutions, not every market has opportunity. But this one did, and it got in, and it made that profit. It was a short time, but nonetheless, it still got in. Let's get rid of some of the noise so we can focus only on the entry point. So as you can see, we got in here and we got out here with a very simple profit. Again, this is a very simple opportunistic approach. It's not made to make large profits. It's made to simply capitalize on short-term opportunities within whatever market it's working. In this case, the 1 hour. So we go to the next opportunity, which is right here. Okay, it's got the opportunity, it bought into the market. It has one position. Then the market turned it downward. And this is where it is at now, waiting for the opportunity to either make another accumulation strategically or to make a profit. But let's go back even further. Okay, there's that opportunity. No opportunities here at all. Okay, here is a whole slew of opportunities. Again, when the market was consolidating, it found 3 opportunities within the market. Potentially more, but we see 3 on the chart. So let's keep going. Okay, we have a rather deep run, which led up to this selling point. An accumulation point, another accumulation point, and 2 more accumulation points in the beginning of this market trend. Again, opportunities, even in this insane market. And that's the point. Opportunities are always available. And it's just a matter of you having the right approach and the right mindset to find them. Trading is about patience, risk management, and budget management. Now, while the longer time frames look nice, they require larger budgets to compensate for the overhead you're going to occur and accumulate to achieve these types of profits. So let's look at a smaller time frame that most retail investors are likely to take advantage of and want to be in. A time frame more resemblant of the last several days to the last month. when the downtrend itself was perhaps the most severest. And as you can see, roughly the last 70 days, there's only been 2 trade cycle opportunities. Now let's go see where they were. And as you can see, we're in a position and we're holding. Not the best position necessarily, but nonetheless, this is the point of a well-rounded accumulation process. To opportunistically get into it at the right time to lower the cost of the average. We had a near miss here around the 31st of May that could have potentially sold off, but it didn't have enough strength. Okay, we're still accumulating. Quite a bit of accumulation, so opportunities are good. And there's not much difference between the price action and the blue average line. Okay, now we're getting a bit of a separation. So this tells me the market wasn't that great in here, but on the 11th, we had a very good entry point, or the algorithm believes it's a good entry point, and from there, it was able to get into the market reasonably well. So that's the current running trade cycle. Let's see and find the previous trade cycle. Okay, this one was a short one. Nice little entry point. And then, not that far away, a nice little exit point. I could do this all day with Ethereum, but I think I've driven the point home. Markets have opportunities. Those opportunities are designed to give you choices. A lot of people right now are losing money because they haven't planned for the worst case scenario. That's why I don't try to predict the future. I try to predict the worst case possible situation I can face with a given approach that I believe will give me both short-term and long-term success in any market. And that is really the whole point. Any market. And in this case, the market trending downward for nearly 6 months has been a perfect example. And actually longer than that. We're at the 8th month of this downtrend. And yet, there is still money to be made for those that practice the science and mathematics of technical analysis and understanding your risks and planning your budget. If you plan for the worst case scenario as commonplace, in this case, my worst case scenario is going to be 100 steps. Now I can limit that based upon the information I have. And that information will give me better control over my budget, better control over my risks. For example, let's go to the 1 minute time frame and find out what it thinks. Okay, it's been a pure downtrend, but even at the 1 minute, it's only made 5 purchases per cycle. Let's see around the 30 minute. Only 4 maximum purchases per cycle. So it looks like the 5-minute was the largest number of purchases per cycle at 17. So if I wanted to plan a stable budget that was below 100 worst case positions, 17, round up to the nearest 10, which is 20, and then double it. 40 positions would be a reasonable outlook for this approach on any time frame to produce reasonable amount of profit. Worst case scenario thinking is always critical. Now, I'm not going to go through and say the market is the apocalypse or any of that, because quite frankly, I don't believe it is. The market is changing. Let's just be realistic about that. It has to change. When you see a market that makes this kind of an extreme cascading uptrend, you have to naturally expect the correction. If you don't, you've only blinded yourself into taking massive losses. The market is about balance. Balance between bullishness and bearishness. Balance between supply and demand. Balance between worth and actual value. Consumers are only going to pay what the product is worth based upon their thinking process. If they believe the product is overpriced, they're not going to buy it. Then the sellers are going to have to decide to lower the price if they want to stay in business. This is no different, and if anything, it's the purest level of looking at that entire market context. The price is overvalued, the price is too high, and now the consumers don't want to buy it. The consumers now want it brought down extremely. That is the whole point of what you are looking at. A market correction based upon real world value and worth of an asset. Now that does bring us to a bigger question, and one that really does need to be addressed for the future of the market itself. I've mentioned this several times about the debit cards being the spearhead driving this process between value and worth. So what if Ethereum never pushed into that market? Same thing with Bitcoin or any other crypto asset. What if they just remained trading commodities not tied to real world worth? Similar to what stocks are. You can't take your Apple stocks into a grocery store and buy food through the process of a debit card. That doesn't work that way. So what if cryptocurrency remained as nothing more than a trading asset based upon the ideology of what it represented? I believe that had it remained as a trading commodity and not tried to become a monetary value point through debit cards and other online means of converting cryptocurrency into real money for the purchase of product, that you would not see these extreme corrective changes. You would still have a natural balance between supply and demand, but I believe the push for debit cards and the push towards a monetary representation with real world understanding is what has spearheaded the extremes within the corrective pattern. You're no longer talking about an asset like a stock where you believe AT&T or Walmart is worth X dollars per share. You're now talking about a commodity that is, in essence, a product purchasing mechanism. I can now go out and buy a dinner I can buy groceries, I can buy a house. Those consequences are just that, consequences to market. The market is now entering the phase that it's going to demand balance between value and worth. Balance between what people think it's worth and what people are really going to pay for the product they want. That, I believe, is where we are at now. I believe the cryptocurrency markets are realizing the consequences of moving from an asset or commodity-based mechanism, the way stocks are, to seeing the kind of fluctuations the Forex market sees. Real world meaning behind the face of the asset. And if you look at the stock market and the Forex market, you see the direct correlation of this representation. One has meaning only towards the value of a business. If stocks go up, that means people have faith in that business doing better. If stocks go down, that means people have lost confidence in that business. The Forex market is based entirely different and subsequently operates very differently. It's based upon the real world meaning of fiat, the real world meaning of the money we buy and sell with every day. The cryptocurrency market right now is in the middle. It has the asset value to worth ratio of the stock market, but because of debit cards and electronic payment systems, it is also now forced to reckon with the concept that people expect uniformity based upon what they're purchasing. I think this battle is going to rage on for a lot longer, and I think ultimately the crypto markets in general are going to find some sort of median range between stock-based asset and Forex-based monetary. And it's going to be a bloodbath in the middle to anybody that doesn't prepare for it. Now we get to the consequences of the bloodbath. And I think that is going to be the futures market. I personally believe the futures market in its entirety and totality is going to suffer major losses. I don't believe the spot markets are going to feel the impact as severely because people that purchase the assets in the stock market, they are holding the asset the way someone would purchase Apple, Google, Facebook, Microsoft, Iron Mountain, AT&T, Verizon. They are purchasing in the spot market for the value of the asset and the representation of that asset. The futures market doesn't do that. The futures market is pure speculation. Technical analysis doesn't actually work very well in the futures market because the futures market is nothing more than people speculating on whether or not the price is going to go up or go down in the future. Technical analysis only works on the data presented in the past. So let's demonstrate this. Let's go to Ether. Let's go to the futures version of Ethereum. The speculation version of Ethereum. Now here, the market doesn't look different because we're looking at the past. And that's the point. This is the past. What is on an exchange for the futures version is entirely different. The order books, the belief system, the thinking process, the people that want Ethereum to succeed, the people that want Ethereum to fail, they are the players of the futures market. It will mimic this to some standard deviation, but that is yet to be seen because it is the future. They are going to be hit the hardest by this transition of the crypto markets from commodity asset to monetary asset. They are going to feel the most pain because ultimately it is going to be that ratio between value and worth that it decides the future of the futures market. So, from there, what I think is going to be the outcome of this. The market is changing. There is no doubt in my mind that those changes are taking place. Corrections are going to continue in every market on every level. There's always going to be a push between supply and demand. There's always going to be people that believe the value of an asset is worth more than it really is. There's always going to be people that believe the value of an asset is worth less than it really is. And that is going to continue on any asset you speak of in the market, no matter what it is. It could be Apple, it could be gold, it could be how much your labor is worth to cut the grass next door. It doesn't matter. You will always have that entanglement between value and worth on any market commodity, even your own labor. That's not going to change. What is going to change is the role that cryptocurrency plays within the commodities market or stocks versus the monetary market, Forex. That role will change. It will either revert back to the commodities market or it will move towards the monetary market, and its price volatility will by necessity have to change appropriate for the value to worth ratios. I personally think there needs to be a little of both. Some assets are not viable currencies or monetary prospects. They are best left in the commodities market like the stocks, working in their own ecosystems based upon the value of whatever they represent. Some assets would work well as monetary assets, as long as the volatility is not too high. The battlegrounds has been clearly laid out between both sides of this spectrum. Only time is going to tell who, if any, is going to survive. I think there are going to be a few survivors. I think there's going to be a lot of casualties. And I think there's simply a lot of garbage in the market that needs to either realize it is nothing more than a commodity and not try to be a monetary value or be liquidated. And most importantly, I think those that are speculating only in the futures market and not actually participating in the spot markets are going to suffer the largest amount of loss. I think the futures market has a place, but it must be tempered with responsibility and care. And this chart tells me that too many people aren't doing that. And they are literally losing millions of dollars because of their own greed. That is really what the futures market represents. The ultimate level of greed at the market level. People wanting more for less. People wanting less for more. It's a dichotomy that is woven into human existence and goes back as far as we have been trading goods and services, and it's not going to come to an end anytime soon. Whether or not the crypto market survives, that is a whole different story. I think to some degree it will at this point. I don't believe this is an Armageddon doomsday note. I don't see the crypto markets on their way out the door collapsing. I do see innovation and changes bringing new opportunities into the future. I see the need of education and a lack of it on the market. And I see people preying on novice traders' weaknesses and lack of knowledge. The scams, the frauds, all of which should be dealt with, but carefully. I see greedy governments over-legislating, thinking that they are protecting their economies, when in reality, they are not. And I see greedy politicians that don't care as long as they get their palms greased. The crypto market at this stage really is in the Wild West state of mind that the stock market was 100 years ago. It will mature, it will grow, it will develop, but it's going to take growing pains to do it. Well, I've rambled on enough about this, but I think you get the point. Very simply put, if you're going to get into this market or any market, understand your risks. Understand your budget. Think about the worst case scenario. We have been in a bull run for so long that people forgot the consequences of a bear run or a bearish trend. They didn't prepare for the realization of what had to occur. Price had to correct. They got greedy and complacent about their investing, and they suffered for it. That is the reality of any and every market. You must not be complacent. As one of my mentors put it when I was learning this whole process at a very young age, you are one step away from bankruptcy and one trade away from losing everything. The deciding factor on that is you and your ability to plan and manage your finances. Give me a like, subscribe, leave me a comment. How have you prepared your markets? How have you prepared for trading? Did you get overconfident? Did you lose in this bullish trend? Let me know. By telling me these things, it helps me focus on the next video and future videos in terms of what information I need to convey to help protect people in the market, to give them the information they need to make informed choices, or possibly to write tools to make it easier to analyze the market. So thank you for watching, and until next time.